The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar. Estate tax mistake costs estate $1.5 million. This webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Limberg, and Linus regularly speaks at industry events. Before I turn the floor over to Linus, we are going to vote on the February webinar. And as a reminder, in January, we will discuss the 2026 updated numbers that you should know. So mark your calendars for that one. The topics up for your consideration for the February webinar are IRS updates 1099-R reporting for QCDs, managing Medicare Part B premiums, or private letter ruling confirms availability of spousal rollover. I'm going to launch the poll and give everybody a minute to vote. All right, it looks like everybody has voted. So the February webinar, we will cover managing Medicare Part B premiums. So please join us for that. And with that, I will go ahead and turn the webinar over to Linus.
Welcome, everyone. I'm pleased that you've joined us for today's webinar titled Estate Tax Mistake Costs a Family $1.5 million. Today's session is part of our webinar series. Each of these webinars is open to those in the life insurance and financial services industries, and they are free of charge. Before we begin, I'd like to remind you that next month's webinar will be held on Wednesday, January 7th at 11 a.m. Central. The topic will be 2026 Key Financial Numbers. If you know of a financial professional who might be interested in one of our monthly topics, feel welcome to invite them to join us. This webinar will last approximately 15 minutes, and let's get started. So we're going to talk about four particular areas of this estate tax mistake. First of all, we're going to start with a brief overview of federal estate taxes. We'll talk about the idea of portability and the idea that portability provides automatic increases to the federal estate tax exemption amount for a married couple. We'll talk about the steps that the IRS expects people to follow to preserve any unused exemption amount at the first spouse's death. And then we'll talk specifically about the mistakes that were made in this case that cost this particular family $1.5 million extra in estate taxes. So let's go ahead and start with a brief overview of federal estate taxes. We've currently got an estate tax exemption amount that is just under $14 million. That exemption amount is scheduled to rise to $15 million next year thanks to the One Big Beautiful Bill Act. It is also scheduled to continue to be indexed to inflation, and so the exemption amount will rise unless and until the federal government changes the rules with regard to federal estate taxes. The current estate tax rate is what it has been for a significant length of time. It is 40%. That is that if we've got a single person worth more than $14 million who dies this year or worth more than $15 million who dies next year, the excess, the amount passing to children, pass to them, but are subject to estate tax at a rate on 40% of the excess. One of the good pieces of news that we've got in the federal estate tax rule is that you're allowed to pass an unlimited amount to your surviving spouse if your surviving spouse is a U.S. citizen without having to worry about estate taxes. But it is at the second death, and it is the second death that we're worried about in this particular court case, where estate taxes are imposed when wealth gets passed to the next generation. Let's talk about the idea of portability. Now, portability has been around, hard for me to believe, it's been around for 15 years now. The idea of portability is that if the surviving spouse doesn't use up her exemption at death, then the unused amount of the exemption available from the first spouse's death transfers to the surviving spouse. The best way to illustrate this is with an example. Let's say that we've got both spouses alive here in late 2025, but one of them passes away and leaves all of his wealth to the surviving spouse, doesn't use the $14 million estate tax exemption. If portability has been preserved, then that $14 million that was unused at the first spouse's death, because all assets went to the surviving spouse and the exemption amount wasn't needed, the $14 million of unused exemption goes to the surviving spouse. If the second spouse also dies in 2025, the potential combined federal estate tax exemptions can be almost $28 million. And that's a big deal for a married couple. It shelters a lot of wealth from the imposition of the federal estate tax. Now, some people are under the mistaken notion that getting the deceased spouse's unused exemption is an automatic thing. It is not. It used to be that we had to do pre-death planning to preserve the exemption amount or use the exemption amount at the first spouse's death. We don't have to do that anymore, but the unused exemption from the first death, its preservation is not automatic. The IRS has very particular rules that have to be followed in order to preserve the unused exemption from the first spouse's death. The easiest way to preserve the exemption amount is to file an estate tax return. An estate tax return is due within 9 months of the date of death of the person who has died from the first spouse's death in this case. You can also ask the IRS for an automatic extension, which is granted. That gives you an extra 6 months. So it makes the actual deadline, if an exemption is, or if an extension is requested, makes the actual deadline 15 months after the date of the death. That's one way to do it, and it's the most straightforward way an estate tax exemption is filed. There's also a special way, which is to follow the rules outlined in a Revenue Procedure 2017-34 in this case, and we'll talk about what those special steps are when we talk about the case that's in front of us. So let's go ahead and talk about that case. We've got the estate of Billy Rowland versus the Commissioner, which was a tax court case decided this year. The tax court was asked to decide a dispute between the IRS and Billy Rowland over the amount of estate tax that was due, and specifically the amount of estate tax exemption that was available at Billy's death. And the key issue here was whether the unused exemption from Fay Rowland's estate, Billy's wife who died before him, was available to Billy's estate. So Fay died in 2016 when the federal estate tax exemption was just under $5.5 million. And according to the facts of the court case, the executor for Fay's estate did not file a timely estate tax return by the extended deadline, which was 15 months after Fay's death. They ultimately mailed Form 706, the estate tax return, just before the end of 2017, and the IRS received it at the beginning of 2018, but it was clearly past the 15-month deadline. Mr. Rowland died in 2018. In early 2019, his estate filed a return, and they claimed the deceased spouse's unused exemption of about $3.7 million. And he added that to his own 2018 estate tax exclusion amount of $11 million and deducted that from his gross estate. And based on the combined exemptions, Billy's estate reported a net estate tax of around $4.5 million. And the IRS examined Billy's return, decided that it improperly claimed Fay's unused exemption, and that the amount of tax that they actually owed was $1.5 million higher, and the tax court was called on to ultimately decide whether Fay's exemption was available to Billy's estate or not. And so remember, we said earlier that there are two ways to claim the unused exemption and preserve it for the surviving spouse. And one way is to file a timely estate tax return, and the other way is to follow the special steps outlined in the revenue procedure. Well, it's clear in this case that the estate tax return for Fay was not filed in a timely way, and so Billy's estate was stuck with arguing that they'd properly followed the steps in the revenue procedure. Now, the revenue procedure says that if you file for portability within 2 years after the decedent's date of death, you can follow the special procedures. And clearly they were within the 2-year deadline in this particular case. They did file an estate tax return on behalf of Fay within that 2-year deadline. Now, in this case, there was a 2-year deadline for asking for the special relief. In 2022, the IRS updated its rule and made the deadline as late as 5 years after the decedent's date of death. And so for those of us who are working with clients currently, where we're trying to manage the exemption amount that is available to the clients, we've got a new deadline of as long as 5 years after the decedent's date of death. Part of the requirement outlined in Revenue Procedure 2017-34 is that a complete and properly prepared Form 706 must be filed along with the request of the IRS to preserve the exemption. And the tax court looked at the form that had been submitted on behalf of Faye, and it decided that the form was not complete. And the reason is that there was no specific valuation information on the form that was submitted for Faye's estate regarding valuation of various properties. Because the form was not specific about valuation, it was impossible to properly calculate the deceased spouse's unused exemption amount. Therefore, because that particular estate tax return, which was filed pursuant to the revenue procedure, couldn't adequately prove what the deceased spouse's unused exemption was, the whole exemption amount that was claimed from Faye's estate was not available to Billy's heirs, and as a result, that $3.7 million not being available meant that Billy's estate had a larger tax liability by $1.5 million. That's the problem of this case. That's the lesson from this case, that you got to follow the procedures properly in order to claim the unused exemption amount. And in this case, failing to do that cost the family $1.5 million. So what are the things that we hope you take away from today's session? First of all, there's an opportunity to talk to clients about estate taxes, right? It's timely in light of the recent changes made as part of the One Big Beautiful Bill Act. Also for those who may be in a position where one spouse has already passed recently, talking about the roll-in case may be prudent. The second thing is that for those who are affected by estate taxes, life insurance and an irrevocable trust is still a tried and true technique for managing those estate taxes that cannot be avoided. And then finally, staying in contact with a family after a high net worth individual passes can provide opportunities, provide a valuable service. If the financial professional had been encouraging the executor to file a timely estate tax return or to provide more complete information on the request under the revenue procedure to preserve the unused exemption, it really could have provided a service. But there are more opportunities to provide services, so staying in touch is really a good thing. So I'd like to thank you again for joining us today. As a reminder, if you'd like to receive the supporting materials I mentioned during the webinar, feel welcome to email us at asktheexpert@advancedunderwriting.com. You can also email questions related to today's content. You can also feel welcome to join us for the next webinar on the first Wednesday of next month, January 7th, this same time. Next month's webinar will be titled 2026 Key Financial Numbers. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. And finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.